I warned you. Silver just collapsed from $83 to $75 in minutes, a full 10% wipeout. But here's what they're not telling you. While Western silver crashed, Shanghai prices held at $82. That's a $7 premium gap, the widest disconnect in modern history. Someone just extracted $400 billion from the market in 90 minutes. This wasn't panic selling. This was surgical extraction. And the Chinese New Year closes Shanghai in 48 hours, which means what happens next will shock everyone who didn't see this coming. But you're about to know exactly what the banks are hiding. Welcome back to Currency Archive, where we decode financial warfare before it hits your wallet. Listen, I need you to do something for me. Just like you'd bookmark an important page in a book you never want to lose. Hit that subscribe button right now, because what I'm about to show you won't be on mainstream news, and I want to make sure you catch every upload before the next move happens. Also, drop a comment below and tell me, where in the world are you watching this from? Because this crisis is global, and I want to know who's paying attention. Now let me show you exactly what just happened. The morning of February 13th, 2026 began like any other trading session. Silver was holding steady at $83 per ounce. Traders watched their screens. Analysts reviewed their charts. Everything appeared normal on the surface. Then, in exactly 90 minutes, everything changed. Silver didn't just fall, it collapsed. The price dropped from $83 to $75 per ounce, a full 9.6% decline in less than 2 hours. $400 billion simply vanished from the global silver market. But this wasn't just about silver. The entire financial system shook. Gold tumbled 3.76%, erasing nearly $1.34 trillion in market value. The S&P 500 fell 1%, wiping out $620 billion. The Nasdaq crashed harder, down 1.6%, destroying $600 billion in wealth. Even cryptocurrency markets bled, dropping 3% and losing $70 billion. In total, $3.6 trillion disappeared from global markets in 90 minutes. Retail investors stared at their accounts in shock. Margin calls started flooding in. Stop-loss orders triggered across thousands of portfolios. Panic spread through trading floors from New York to London to Singapore. But seasoned technical analysts had seen the warning signs. Days before the crash, the charts were screaming danger. The 150 exponential moving average on the hourly chart was acting as resistance, not support. This is a critical distinction that separates professional traders from amateurs. When price sits above this moving average, it acts as a floor. Buyers step in, the trend continues upward, but when price falls below it, the dynamic reverses completely. That same line becomes a ceiling. Sellers dominate. Downward pressure intensifies. Silver had crossed below this threshold. The structure was bearish. The technical setup pointed to further decline. Yet most market participants ignored these signals. They believed in the silver rally. They bought on emotion rather than evidence. They paid the price for that mistake. What made this crash particularly disturbing was not just the speed or the magnitude, it was the mechanism behind it. This wasn't random market panic. The volume patterns didn't match a natural sell-off. There were no obvious fundamental triggers, no emergency Fed announcements, no geopolitical shocks, no corporate bankruptcies, just a sudden surgical extraction of value. While Western markets burned, something strange was happening in the East. Shanghai spot silver was trading at $82 per ounce. The same metal, the same moment in time, but a $7 price difference. This wasn't a small arbitrage opportunity. This was a massive structural disconnect. In normal markets, such gaps close within minutes through algorithmic trading. Sophisticated firms deploy millions in capital to exploit even tiny price differences between exchanges. But this gap remained. It persisted. It widened. The Shanghai Metal Exchange was preparing to close for Chinese New Year. From February 15th through February 23rd, Eastern markets would go dark for 8 full days. No trading, no price discovery, no liquidity. Western institutions knew this. They understood the calendar. They recognized the window of opportunity closing. The SLV Silver ETF began trading at a significant discount to its net asset value. This technical condition created a specific arbitrage mechanism. Banks could purchase cheap SLV shares, redeem them for physical silver, and deliver that metal against their short positions. In simple terms, they were using the ETF structure to settle paper obligations with actual metal while simultaneously removing physical silver from public circulation. The price crashed on paper markets while physical supply quietly transferred into institutional vaults. This wasn't price discovery. This was price engineering. Young entrepreneurs and business owners watching this unfold faced a critical decision point. Their cash reserves were denominated in currencies backed by nothing but government promises. Their business treasuries sat in money market funds earning 5%, while real inflation consumed 8% of purchasing power annually. The silver crash wasn't just a commodity story, it was a warning signal about the entire monetary system. When Western paper markets and Eastern physical markets trade the same asset at drastically different prices, the system itself is fragmenting. The question wasn't whether this crash was manipulation. The evidence was clear. The real question was, what happens next when Shanghai reopens and reprices silver independently from Western paper markets? 48 hours remained before the world would find out. Most people think markets are simple. A buyer meets a seller, they agree on a price. The transaction completes, everyone moves on. The reality is far more sinister. Behind every major price collapse in precious metals, there exists a hidden architecture, a mechanism so sophisticated that most traders never see it coming, even when they're looking directly at it. February 13th, 2026 wasn't just another bad day for silver, it was a masterclass in financial engineering. The weapon of choice was the SLV ETF, the iShares Silver Trust. On paper, it's a simple investment vehicle. Investors buy shares. Those shares represent ownership of physical silver stored in vaults. The net asset value tracks the actual metal backing each share, except when it doesn't. On this particular morning, SLV began trading at a discount to its net asset value. Not a small discount, a significant one, large enough to trigger a specific type of institutional behavior that retail investors rarely understand. This discount created what insiders call an arbitrage window. Here's how the extraction works. A handful of firms hold special status as authorized participants. These aren't regular traders. They're institutional giants with direct access to the ETF's creation and redemption mechanism. They can buy discounted SLV shares on the open market, bundle them in blocks of 50,000 shares, and redeem them directly with the trust. In exchange, they receive physical silver bars, real metal, deliverable against contracts. Now here's where it gets interesting. Many of these same institutions hold massive short positions in silver futures. They've sold contracts promising to deliver silver they don't actually own. These are called naked shorts. In a normal market, this creates risk. If the price rises, they must buy expensive silver to cover their obligations. But when SLV trades at a discount, the game changes completely. They purchase cheap ETF shares, redeem them for physical metal, deliver that metal against their short positions, close their exposure. And here's the critical part. They've just removed physical silver from public circulation while simultaneously crashing the paper price. The beauty of this mechanism, from their perspective, is that it requires no explanation. No press releases, no regulatory filings that trigger scrutiny. The price simply falls. Retail investors see red on their screens. They panic, they sell. The cycle accelerates. Volume data from February 13th revealed something peculiar. The price dropped 9.6%, but trading volume wasn't proportionally elevated. In genuine panic selling, volume explodes. Everyone rushes for the exits simultaneously. Orders pile up. The tape runs wild. That didn't happen here. Instead, the price declined smoothly, methodically, almost algorithmically. This is the signature of spoofing. Large sell orders appear on the books, creating the illusion of massive selling pressure. The price drops, then those orders vanish. Before execution, the pattern repeats. It's illegal. Traders have been prosecuted for it, but proving spoofing in real time is nearly impossible. By the time regulators investigate, the damage is done. The money is moved. The physical metal has transferred hands. Historical patterns support this analysis. The 2020 gold suppression followed identical mechanics. March of that year saw gold crash from $1,700 to $1,450 in days. GLD, the gold ETF, traded at steep discounts. Authorized participants extracted over 300 tons of physical gold. The paper price collapsed while physical premiums soared. The 2013 silver crash told the same story. Price dropped from $32 to $18 in months. SLV inventory declined by 20%. Physical coins and bars sold at premiums of 15-25% above spot price. The divergence between paper and physical became undeniable. Now, in February 2026, the pattern was repeating with even greater intensity. The timing wasn't coincidental. Shanghai Metal Exchange would close in less than 48 hours for Chinese New Year. 8 days of darkness. No Eastern price discovery, no competing bids for physical metal. Western institutions had a limited window to execute maximum extraction. SEC filings from the weeks prior showed increased activity among authorized participants. Redemption requests spiked, physical withdrawals accelerated. The data was public, verifiable, yet financial media remained silent. Meanwhile, physical silver premiums were expanding globally. Coin dealers reported delivery delays. Wholesale distributors faced allocation restrictions. The spot price said silver was abundant and falling. The physical market said the opposite. This contradiction reveals the fundamental flaw in paper precious metals markets. They were designed to provide exposure without the inconvenience of physical ownership. But somewhere along the way, they became tools for price suppression. The mechanism works because most SLV holders never redeem for physical. They trade the shares like stocks. They trust the system. They assume the metal exists in vaults backing their investment, and it does, until authorized participants remove it. For young business owners watching this unfold, the lesson was clear. Paper assets and physical assets are not the same thing. When stress enters the system, that distinction becomes everything. The extraction was complete. The price had crashed, and Shanghai was about to go dark. There's a number that changes everything. $7. On February 13th, 2026, while Western traders watched silver collapse to $75, something extraordinary was happening 8 time zones away. Shanghai was pricing the exact same metal at $82 per ounce. The same element, the same atomic structure, the same industrial commodity, yet somehow simultaneously worth 2 different prices in 2 different parts of the world. This wasn't a glitch. This was a declaration of war. In traditional commodities markets, price discrepancies vanish almost instantly. Algorithmic traders exist specifically to exploit these gaps. If gold trades for $10 more in London than New York, capital floods the cheaper market within seconds. The gap closes, equilibrium returns. But this $7 premium wasn't closing, it was widening. Beijing had been watching Western precious metals manipulation for decades, quietly, patiently. Every time Western banks smashed gold or silver prices on paper markets, Chinese state institutions accumulated physical metal at discount prices. They never complained. They never protested to international regulatory bodies. They simply bought more. The People's Bank of China had been adding to gold reserves every single month for the past 18 months. Official reports showed steady accumulation. But those were just the disclosed purchases. Analysts, tracking import data through Hong Kong and Switzerland, estimated actual accumulation ran 3 to 5 times higher than official figures. China wasn't preparing for a financial crisis. China was preparing for a financial reset. The BRICS nations, Brazil, Russia, India, China, and South Africa, had been developing alternative settlement systems for years. Western financial media dismissed these efforts as symbolic gestures. Developing nations playing at economic independence while remaining dependent on dollar-based trade. That assessment was catastrophically wrong. In private meetings throughout 2024 and 2025, BRICS finance ministers had been engineering something unprecedented, a commodity-backed trade settlement system, not pegged to any single currency, not dependent on Western banking infrastructure, instead anchored to baskets of precious metals with transparent pricing mechanisms. The system was nearly operational. Russia had already begun selling oil to China and India with settlement and gold-backed instruments. Saudi Arabia was quietly diversifying reserves away from pure dollar holdings into physical metals stored in Swiss and Singaporean vaults. The United Arab Emirates had become one of the world's largest gold import hubs, processing thousands of tons annually. The geopolitical architecture was shifting beneath the surface, while Western economists insisted dollar dominance would last forever. Meanwhile, the United States faced mathematical impossibility. $36 trillion in national debt, annual deficits exceeding $2 trillion. Debt service costs consuming 15% of the federal budget and rising with every interest rate increase. The Federal Reserve was trapped. Raise rates to fight inflation, and the government's debt payments become unsustainable. Lower rates, and inflation devours purchasing power. There was no clean exit from this dilemma, except one: suppress precious metals prices to maintain the illusion of dollar stability. If gold and silver surged to reflect actual currency debasement, it would trigger a crisis of confidence in dollar-denominated assets. Treasury bonds would sell off. Yields would spike. Debt service would explode. The entire structure would unravel. So Western central banks had to prevent that surge, by any means necessary. This explained the timing of the February 13th crash. Chinese New Year would close Shanghai from February 15th to February 23, 8 days without Eastern markets providing price competition. 8 days where Western institutions could drive paper prices lower without interference from physical buyers. But there was a problem with this strategy. It only worked if Eastern markets continued accepting Western price discovery, and they were about to stop. India's central bank had increased gold reserves by 27% in the previous year. Not gold ETFs, not gold futures. Physical bars stored in domestic vaults. Turkey had repatriated 220 tons of gold from Federal Reserve custody in New York. Poland withdrew 100 tons from the Bank of England. These weren't random decisions. These were strategic preparations. The $7 premium between Shanghai and Western markets was a signal. It meant Chinese buyers no longer trusted Western price mechanisms. They were willing to pay significantly more for physical delivery because they understood something crucial. Paper markets can print infinite contracts, but physical mines can only produce finite metal. Young entrepreneurs studying this situation needed to understand the stakes. This wasn't about investment returns or portfolio diversification. This was about the fundamental restructuring of global monetary architecture. For 70 years, the dollar had been the world's reserve currency, not because of American economic superiority, but because oil traded exclusively in dollars. forcing every nation to hold dollar reserves. That petrodollar system was dying. Saudi Arabia had already begun accepting yuan for oil sales to China. Russia was selling energy to Europe through alternative settlement mechanisms. The exclusive dollar grip was loosening. When reserve currency status erodes, it doesn't happen gradually. It happens in stages of sudden recognition. The British pound dominated global trade for centuries. Then, within a decade after World War II, it was largely irrelevant. The same pattern was emerging now. Western institutions were extracting physical silver and gold while crashing paper prices because they knew what was coming. When Eastern and Western precious metals markets permanently decouple, dollar purchasing power would accelerate downward. History provided clear precedent. Weimar Germany suppressed gold prices through official channels, while hyperinflation destroyed the mark. Zimbabwe's central bank insisted gold was stable, while the Zimbabwe dollar collapsed. Venezuela maintained official precious metals pricing, while black market rates ran 50 times higher. The pattern always ended the same way. Official prices became irrelevant. Physical metal traded at massive premiums. Currency holders were wiped out. Shanghai would reopen in 8 days. The question wasn't whether they would reprice silver independently. The question was by how much, and whether Western markets would be forced to acknowledge the new reality. 48 hours had passed since the crash. The clock was ticking toward monetary checkmate. The crash had happened. The mechanism was exposed. The geopolitical board was set. Now came the only question that actually mattered for business owners. What do you do next? Most entrepreneurs never think about currency risk. They focus on products, customers, marketing, operations. They check their bank account balance and feel secure when the number is large. They assume dollars today will buy the same amount tomorrow. That assumption is killing businesses quietly. Official inflation numbers claim 3% annually. The government releases these figures monthly. Financial media repeats them without question. Business owners budget accordingly, expecting modest price increases in their supply chains. But reality tells a different story. Commercial rent increases are running 7 to 9% annually in major cities. Raw material costs for manufacturing have risen 12-15% since 2024. Shipping and logistics expenses are up 18%. Health insurance premiums for employees have climbed 11%. Energy costs fluctuate, but trend consistently upward. The real inflation rate, the one actually impacting business operations, runs somewhere between 7% and 9% annually. Not 3%, not even close. This creates a silent wealth transfer. A company holding $500,000 in cash reserves loses $35,000 to $45,000 in real purchasing power every year. Money market funds paying 5% interest don't compensate for 8% real inflation. The business is getting poorer while the bank balance stays the same. Young business owners face a critical decision. Continue operating under the assumption that cash is safe, or recognize that cash is a depreciating asset requiring strategic defense. The traditional advice is simple. Keep 3 to 6 months of operating expenses in liquid reserves. Anything beyond that gets reinvested into growth. Expand inventory. Hire staff. Increase marketing. Scale operations. But what happens when the currency itself becomes unreliable? The February 13th silver crash provided a case study. While paper prices collapsed 9.6%, physical premiums expanded. Retail coin dealers were selling silver eagles at $8.10 above spot price. Wholesale distributors faced allocation limits. The price said silver was abundant. The physical market said otherwise. This divergence revealed an opportunity. Businesses with excess cash could acquire physical precious metals at temporarily suppressed prices, not as speculation, not as investment, as insurance against currency debasement. The allocation percentage matters. A small business putting 50% of reserves into physical metals would face liquidity problems during normal operations. But a strategic 15% allocation provides meaningful protection without compromising operational flexibility. The choice of vehicle matters even more. SLV and GLD offer convenience. They trade like stocks. They provide instant liquidity. They appear on brokerage statements alongside other holdings. But the February 13th mechanism proved these ETFs serve a different purpose. They're extraction tools for authorized participants. When stress enters the system, physical metal leaves the trust. Shareholders own claims on metal that may not exist when they need it most. Allocated physical storage operates differently. The business owns specific bars with serial numbers. Those bars sit in segregated vaults under the company's name. No rehypothecation, no lending, no authorized participant redemptions, just metal that belongs exclusively to the entity that purchased it. Geographic diversification adds another layer of protection. Storing all precious metals in a single jurisdiction creates political risk. Governments facing fiscal crisis have historically confiscated gold. Executive Order 6102 in 1933 forced American citizens to surrender gold to the Federal Reserve at fixed prices. It happened before. It could happen again. The accounting treatment requires proper documentation. Precious metals held as reserves need clear classification. They're not inventory. They're not investments for trading. They're strategic reserves held against currency devaluation. The distinction matters for tax treatment and financial reporting. Now came the timing question. The Shanghai Metal Exchange would reopen February 23rd, 8 days of closure. When trading resumed, Eastern markets would likely reprice silver independently from Western paper markets. If Shanghai reopened with silver at $85 or $90 while Western spot remained at $75, the permanent decoupling would be undeniable. Physical premiums would explode globally. Retail buyers would panic. Supply would tighten dramatically. Business owners who waited for confirmation would pay significantly higher prices. Those who acted during the manufactured crash acquired metal at artificial discounts. This wasn't about predicting exact price movements. This was about recognizing structural instability and positioning accordingly. Historical parallels reinforced the urgency. In Weimar Germany during the early 1920s, businesses holding cash reserves were destroyed. Those holding physical assets, real estate, commodities, precious metals, survived the hyperinflation. The difference wasn't intelligence or luck, it was asset selection. Zimbabwe's collapse in 2008 followed identical patterns. Companies maintaining dollar reserves thought they were safe because Zimbabwe's currency was obviously unstable. But when the dollar itself faces debasement, there is no safe paper currency, only physical assets retain value. Venezuela provided the most recent example. Businesses holding Bolivar reserves were wiped out. Those holding dollars survived longer but still lost purchasing power. Those holding physical gold maintained operational capability throughout the crisis. The pattern was consistent across every currency collapse in modern history. Paper loses, physical survives. Young entrepreneurs building businesses in 2026 faced a choice their parents never confronted. Previous generations could safely hold cash reserves because the dollar maintained relative stability. Inflation existed, but remained manageable. The system functioned. That system was fragmenting. The $7 premium between Shanghai and Western silver markets wasn't a temporary anomaly. It was the beginning of a permanent repricing. When Eastern and Western precious metals markets trade at sustained different prices, the global monetary system has split into competing spheres. The business survival protocol was straightforward. First, calculate real inflation impacting operations, not official statistics. Second, determine excess cash reserves beyond 3 to 6 months operating expenses. Third, allocate $5 to 15% of those excess reserves into allocated physical precious metals with geographic diversification. Fourth, maintain proper documentation for accounting and tax purposes. Fifth, monitor the Shanghai reopening and Eastern market pricing behavior. This wasn't financial advice, this was pattern recognition. The February 13th crash was a transfer event. Physical metal moved from Western paper holders to Eastern physical accumulators. Retail investors saw losses. Institutional players saw opportunity. Business owners had 48 hours before Shanghai reopened. The decision wasn't whether to act. The decision was whether to recognize what was happening before everyone else figured it out. The crash wasn't the end of the story. It was the opening move in a much larger game, and the players who understood the rules would be the ones still standing when the dust settled.